Hi, I'm Roger Schluter. This video is about what is a bank accounts receivable loan. A accounts receivable loan and inventory loan. Banks, they can and they do lend on company accounts receivable and inventory. I know you probably think that's kind of weird, or maybe you are, well versed, and maybe you do know about this. But it is one of those things that a lot of people don't realize. Very small companies, a lot of times you're not giving people credit, so you don't have accounts receivable. And then it depends on the value of your inventory also. It is riskier lending because these assets are not easily saleable. I mean, if you think about it, would you want to buy somebody else's accounts receivable? And that is, that is money that this company has lent to another company. They at least let them pay it off later. And sometimes those people don't pay back that money. So you never know. So there's a risk. There's a risk to it. This type of lending works best when you're talking larger companies with larger accounts receivable and inventory base. The bank, what it does is it lends on a percentage of eligible accounts receivable, and then it also will do a percentage of inventory. Now you ask, okay, what's the eligible accounts receivable? The eligible accounts receivable is going to be the well, first, let me go through what the bank will need from you. They will need a listing. Now, I'm going to try to put my listing up here somewhere. They are going to need a listing of your what they call a listing and aging of your accounts receivable. So the bank will want to see this listing of your a listing is listing all the items, and if you look over here on the left, they'll be listed down. And then they'll want to see an aging of those same accounts receivable. If the bank's going to do an account receivable loan, they're going to want to know, like I said, they're going to want to know what are eligible accounts receivable. So they're basically going to say want a listing and aging of accounts receivable. Now the listing, if you can see the page up here, it's just the list of the different companies, and that'll be from top to bottom, that list. And then off to the right, to the right of it, I got to try to figure out. Anyway, to the right would basically be the current, how much of their account receivable is current, and then they go 30 days, 60 days, 90 days, and then some of them have 120 days, and then some of them have over 90 or over 120. Most banks will only, their eligible accounts receivable are usually anything within 90 days. So basically, anything over that is not your eligible accounts receivable. Once they have the eligible accounts receivable, then they're going to do a percentage of that eligible account receivable. And then the inventory is a little different. Inventory, you're not going to have eligible, you're just going to have inventory, and they're just going to give you a percentage of it. Will probably be less. It really depends on the inventory, though. The companies, sometimes they'll give the, when they do this, when you have accounts receivable financing, sometimes the company that's giving the financing will actually give what they call terms. And they'll say, oh, well, if you pay it in 30 days, or if you pay it current, right when you get the bill, or 30 days, then, hey, we'll give you a discount of like 5% or 2% or 1%. And so then, but, that goes away if it's longer than that. Some terms could be longer. If it's a really good customer and they pay their bills all the time, you may give them more. You may say, hey, you don't have to pay this bill till 60 to 90 days from now if you don't want to. And so it really depends. The person who's basically, you're basically given financing when you're given, when you're given company terms. And so when you're giving them financing, it really depends on how you have that set up individually. If you have a very small company, you probably may have never even heard of accounts receivable financing. Um, a lot of your really large companies, large, well-established companies, example would be Boeing, InBev, maybe Walmart. I worked earlier in my career, I worked for the state of Missouri, and we help companies get loans and help them do business with other companies. And every company, if they ever got a Walmart account, they were so excited. I'm going to sell my stuff to Walmart. I'm going to make a fortune. And that's true. They sometimes do. But a lot of times how Walmart would do it, I don't know if they still do it this way. They used to do it. Anyway, this is what I heard from people, so I don't know. Walmart, don't sue me or anything. But anyway, what they would do is they would say, hey, how much for this one widget? How much this thing you're making, this dog food or this dog collar or this shirt or whatever it is, how much is one of them? And so the guy would say, oh my God, I could make that for this. And he'd give them usually a pretty kind of lowball figure because it's Walmart. He wants them to buy the heck out of it, And so anyway, then Walmart turns around and says, okay, how much if we, how much, what's it going to, is it going to be the same price if we order like 10,000 of them? And the guy says, well, yeah, sure. He's thinking this is going to be a pretty hard thing to do. But anyway, then they say, okay, give us 500,000 and we expect delivery in 3 months. And sometimes companies go out of business just trying to make that work. It's very hard to do. So sometimes bigger companies are harder to deal with. Now, sometimes they may take you under their wing and they might say, hey, we're going to help you. We're going to sell your products for you and everything. So, but it does depend. And sometimes you can get taken by a larger entity because you want to do business with them. And sometimes you'll let them pay late. I've heard that about a lot of larger companies because, they would say, they wouldn't pay them. And if you're a little guy and you've got a lot of business with this large company, and you don't want to lose that business you got with that large company, then what are you going to do? You're going to take them to court or something? I mean, that'd be a good way to lose that business. So a lot of times you just stretch them out, how far they go. Sometimes they go 120 days, sometimes they go more than that. And if you want to do business with them, you'll just put up with them paying late. And there's really not a whole lot you can do about it other than take your business elsewhere. The borrowing base formula is what the banks go by. And basically it's your current to 90 days due. This is your eligible accounts receivable. And then the bank takes a percentage of that eligible receivable. The percentage really based on how the bank values the receivables and the company. If you're giving accounts receivable financing to Joe Blow down the street, I'm sorry, but the banks aren't going to think that highly of it. If you've got like Boeing or something, then they're going to say, whoa, yeah, we want to do that. We'll finance whatever you want, whatever you have with them. So anyway, the amount it's literally a moving target because let's face it, you've got accounts receivable, or hopefully if you're selling all the time, then your accounts receivable are going up and down with individual companies, and you may bring on new companies. So, I mean, this eligible could be a moving target, and it could change quite a bit. The percentage of the eligible will not change usually. They're going to set that at a certain amount based on who your accounts receivable customers are. The banks, they usually will charge more for this type of financing because they have to have somebody at the bank who calculates it. I mean, even if they have a lot of it automated, they still got to have somebody look at it. They got to have somebody to calculate or watch the formula, which does make it more expensive for the bank. So banks, I mean, interest rate, it really depends on who you are. It depends on who the customers are, and it depends on kind of the work involved in this. And they aren't going to take your word for it. They're going to go back and prove the numbers. So anyway, and the definition, I guess, for some people that don't really understand what accounts receivable are, And you probably figured it out by now. But anyway, a company sells a product and offers terms to the buyer. He might say, and he might not give any discounts. He might just say, the terms are, when you get this widget, then you got to pay us within 30 days, or within 60 days, or within 30 to 60 days, or they could give you a discount to pay it right when it's due. So anyway, that's really the definition. And then when you sell that, you haven't gotten cash. You're basically giving these people a loan. So basically, where you add it all up is an accounts receivable, and it's an asset account that's just underneath cash. In accounts receivable, they are an asset. So you got cash, you got accounts receivable, and then you have inventory. So anyway, and it's a very important part of the balance sheet that you have. When you've got some of these receivables, you're really, hoping the customer will pay their debts on the time allotted, and they'll pay them on time. Usually the banks can lend up to 90% of eligible accounts receivable. Inventory may get up to 60%, but it really depends on the value of that inventory. And then that 90%, I mean, I wouldn't guarantee it. It really depends on who has the accounts receivable, who you've given, basically a loan to, and their strength. And then it also depends on your strength too, your company. So really the bank, I mean, maybe they're only going to give you 60%, maybe, but usually it's above 50. And then inventory is usually less. And it depends on that inventory, because a lot of times inventory isn't that saleable. I can't just go down the street and sell it. I got to find a buyer for that inventory. The term is usually 1 year. Usually the bank will like to renew it yearly. And really that's because they want to be able to shut this down if the loan, if you're not paying well, or if they foresee problems by looking at your financials, they want to be able to stop it. So they're not going to want to be locked into this for years. If the company pays as agreed, pays their account receivable, it usually is paid by the cash cycle, and basically you'll pay it down, the loan that you get from the bank. These loans are kind of a line of credit, and but it'll always be renewed usually for the next year, and then if you do well the next year, it'll be renewed the next year. But they usually only do it 1 year at a time. Basically it's one kind of a line of credit. Now I've got a video coming up where I talk about SBA has a line of credit, and they call it cap lines. And it's kind of complicated because they have 4 cap lines. So I'm not going to get into it in this video because it would take ages. But anyway, I'll cover it in a very near future video. I'll cover the cap lines by SBA. One of the things about cap lines is SBA will do them for a number of years. And, I guess it's okay because, the borrower's getting the guarantee, or the bank is getting the guarantee. But, banks don't like to do loans like this for more than a year. So I think that's kind of the problem with some banks using the cap lines. But we'll get into that later. Anyway, thank you very much. I appreciate you sticking around this long. If you like this kind of content, I'm probably going to put out about 2 a week. So if you would subscribe, it'd be great. And hit the notifications bell to hear for future videos. And then, if you got some value out of this, I hope you hit the like button. And thank you very much. And I'll see you in the next video.